We're here at the Investment Company Institute in Washington, their annual conference here. 1 out of every $4 of Americans' financial assets are run basically by the individuals who are here today, the mutual fund ETF complexes around the country. Roughly a third or more of Americans' 401k money is in mutual funds. Bill McNabb runs Vanguard and is chairman of the ICI. Bill, it's great to have you here.
Thanks, Tyler. It's good to see you again.
Nice to be here. You know, I was looking at some numbers. I want to get them right. Since 2007 through 14, index fund inflows, $1 trillion. Actively managed mutual funds outflows, $659 billion. Have the index funds won? Are you ready to declare victory?
I think what you're seeing is two things. One, it's the triumph of low-cost investing, and I do think that's a secular trend, and it's a trend that's going to continue. Is there an element of cyclicality in it? Sure. You know, active funds go through periods where they outperform their benchmarks. We've been in a period where there's been prolonged underperformance. But I would tell you, from our perspective, it's a very, very difficult thing for an active fund to outperform an index fund because of the cost differential. And so that, to me, is the real secular trend that's being demonstrated by those numbers.
We just talked in our last hour with Jim Ross of State Street about ETFs. You are a big player in the ETF universe as well. Have ETFs evolved in a good way, or have they become something that they really weren't intended to be, namely a trading vehicle?
So I think it's a little of both, to be fair. So the way we view ETFs, as you know, is just another form of indexing. In fact, the way we run our ETFs, they're just a separate share class of our broader index funds. And we continue to promote the idea that it's buy and hold, long-term, periodically rebalance. Now, can ETFs be traded? Yes. Do some people trade them? Yes. And we don't think that's good. There were periods in the 80s and 90s where people did the same thing with traditional funds, and again, their results weren't very good.
Yeah.
So we continue to push this idea of long-term.
I want to get to your op-ed piece in the Wall Street Journal today in just a minute, but I also want to ask you about Janet Yellen's comments yesterday about the level of the valuations of stock prices, number one, and number two, the move to higher interest rates. How do you feel about the market at these levels, and do you think the investors in Vanguard's funds are ready for rising interest rates and what that could mean to the share value of their bond funds?
Well, I think rising rates are inevitable at some point, although it's certainly been a lot longer than anybody would have anticipated. I think a lot of it's going to depend, Tyler, on how quickly they rise. Our best sense is that the rate increases will be relatively metered out, if you will, and be fairly steady and gradual, and probably in smaller increments than a lot of people anticipate. I think investors will be able to handle that, and again, we've put a lot of education material out there to encourage people to understand how rising rates do affect their bonds.
Do you have a view on the level of stock prices today?
On stock prices, we think stocks are valued at really kind of the highest decile if you look at historical returns. And what that suggests to us, and again, we're very plain spoken about this, is over the next decade, stock returns are likely to be a couple hundred basis points below long-term averages. And we've been trying to educate people about that.
Now let's get to that Wall Street Journal article that you had today about the proposals of federal regulators to designate certain mutual fund complexes, big ones like yours, as systemically significant financial institutions, which in your view is a bad idea. Why?
So a lot of this is coming out of Europe originally. The Financial Stability Board has issued a series of consultations where they look at size as being a potential determinant of financial instability. We don't think size has anything to do with it. We think there are certain activities out there that could be potentially systemically important. Those activities should be looked at, but merely designating a firm or a fund, because it's large, actually seems counterintuitive to us.
And in the last analysis, these assets are not the fund company's assets, they are the shareholders' assets.
And the shareholder bears the risk and the reward of how they perform. It's very different than a bank. And so if you sort of cut through my editorial, it's don't apply bank regulations to non-bank business model.
Final question. Sure. I invited you to declare victory of index funds. I'm now going to invite you to declare victory over, in the bond fund universe, your total bond market index fund is now the biggest on earth, bigger even than PIMCO. You want to gloat a little?
No, I don't, because actually I wouldn't have known it except that
Until
the Wall
we
Street
reported
you
it,
reported it, and the Journal reported it. Again, for us, the only thing that matters is getting up every day and doing a great job for our investors. We've been very privileged to be rewarded for that, and we've seen that fund, which had a very simple start in 1986. To see it where it's at, it's gratifying. It means the message is resonating.
Bill, we thank you for coming. You came right off the stage. You were there interviewing PepsiCo's Indra Nooyi. You didn't offer her a Coke, did you?
I did not. I actually offered to be in a Gatorade commercial, but she turned me down.
All right. Bill McNabb of Vanguard, thank you very much. Appreciate you being with us.